Good afternoon, everyone. Thank you for joining us. Welcome to the Dialogue Series session. I'm Anjal from the AASB. The Dialogue Series is held jointly with CPA and CANZ, and the topic for today is R&D reporting under IFRS. The session will be chaired by WSB Research Director Dr. Eric Lee. Please note that the views shared in this session are not the views of the presenter's organization, but their personal views. The session will be recorded and made available on the WSB website. Also, you are welcome to ask any questions using the Q&A function, and we will try to answer your questions if time allows. And with that, I'll hand it over to Eric.
Thanks, Anchal, and welcome everyone. So today we're discussing an important topic, research and development, accounting and reporting. As we all know, many businesses today rely on R&D activities to sustain innovation and growth. And this topic also connects closely to the IASB's broader work on intangible assets. We'll begin with the presentation on recent research, followed by a panel discussion. And during the panel discussion, we'll hear investor perspectives on what information they want to see, the financial reporting and accounting challenges that may need attention, and how narrative reporting can better communicate R&D activities. And we also open the floor for audience questions, so please ask questions away if you like. So to start, we have a presentation from Dr. Fanis Zalikas. I hope I pronounced his surname right. And he's from the University of Bath. And this research is a joint project with Professor Yanis Zalavutas from the University of Glasgow. Fanis, I'm going to hand this presentation over to you.
Thank you, Eric. Let me start by sharing my slides, which they should be up now. Can you see the slides? Is that working? Yes?
No, Fanis, we haven't got the slides up. Excellent.
Has
we can
it
see it
finished
now.
loading now?
Yeah.
Excellent. So
Thank you.
Thank you, Eric. Good afternoon, everyone, and good morning, depending on your time zone. First of all, thank you all for joining today, and thank you to Eric and the WSB for organizing this dialogue series and giving us the opportunity to present today. Both Yanis and myself have published quite a few articles on the topic of R&D and explicitly under IFRSs. In fact, we have 7 joint publications focusing on R&D, 2 reports published with ACCA, again focusing explicitly on R&D, along with other work we've done on the area of intangibles. And also we're academic fellows at the WASB working again on the project of intangibles. And given the work we have done on this area, a few months ago, we decided to do a literature review study, which is what I will be presenting really today. Along on the team in the literature review is Professor Richard Slack of the Durham University. Right? Now, before going into the details of the literature review and what are the key themes that are rising, it would be really nice to talk about the development of IAS 38, just to steer a little bit more the discussion. The standard itself was developed as an accounting standard for R&D, and initially back in the 70s required immediate expensing of all R&D expenditure, very similar to the US approach, if you wish, expensing all R&D. Then IAS 9 came into effect in the 1980s and introduced an optional capitalization subject to the criteria being met for the expenditure. Then there was a little bit of a debate between the International Accounting Standards Committee that favored conditional capitalization and the International Organization of Securities Commission arguing that effective capitalization could impair the comparability of the financial statements. Despite these concerns, effective from January 1995, from 1st of January 1995, the revised IAS 9 was formally adopted, and it mandated conditional capitalization. Right? And then, effective from 1999, IAS 38 was issued, and Effectively, this is the standard we know it as now, and it combines the requirements to all internally generated intangible assets under one standard, right? And this is the standard as we have it now and as it is currently being applied. Something to keep in mind, paragraph 57 lists the capitalization criteria. So any expenditure that meets all the criteria in paragraph 57 should be recognized as an asset on the balance sheet. Interestingly, paragraph 118 indicates the related financial disclosures that companies need to make, and these tend to be things like the reconciliation of the asset during the year, whether the asset is a finite or indefinite asset, the amortization method, and so on. Right? Beyond this, there are no other requirements apart from a requirement in paragraph 128, which encourages companies to disclose information about intangible assets not meeting the recognition criteria. Right? And again, this is not a requirement, it's an encouragement as stipulated in paragraph 128. Now, given when the standard itself was issued, there have been a lot of critiques within academia and also outside academia. And these critiques are effectively indicating that the standard may be a little bit dated. It was originally designed back in the 80s and 90s, and it was explicitly designed for R&D, right? And that has attracted a lot of attention and a lot of debate, questioning whether the definition and the recognition criteria are relevant for the 21st century, and whether effectively the drivers of value creation are recognized in the financial statements. In fact, there has been criticism of financial reports and the accounts may have become less useful. And I'm pretty sure the textbook by Lev and Goose sits in many offices. But what has the ISB done so far, and where is it going? Right. Before the 2015 agenda consultation, the research program included a project on intangible assets, R&D, and extractive activities. Right? After the completion of the agenda consultation, the feedback statement for agenda consultation, the board narrowed the scope to only one of those projects and to cover only extractive activities. Right? Nevertheless, fast forward to 2022, the project was added in the research pipeline, and there has been an IFRS discussion paper that has been quite influential in the whole process. And then in 2024, the project on intangibles was added on the research work plan. Quite a lot of work has taken place during 2025 and at the beginning of 2026, mostly on consultation and review process. And currently, we are at a stage where we're waiting for the IASB to decide on the project direction. Right? So if you wish, this is the background and where we are so far. Against this background and the work I've done with Yanis over the years on R&D, as I said earlier on, we decided to do a literature review paper that aims to review and summarize the academic evidence and outline some suggestions for future research. And we do so by drawing both on practice relevant reports, so non-academic publications, and also academic publications by looking at articles which are published in journals indexed by the Academic Journal Guide, and employ firms reporting under IFRS. And that includes firms that report to local standards that have converged to IFRS. Right? Obviously, for the purpose of this presentation, I'm only going to focus on the review of the academic evidence, just to keep it shorter, more to the point, and to sort of steer a little bit of discussion after the end of this presentation. We have identified 54 publications, and here I list the number of publications per year, with the first publication in 2008 and quite a few published this year in 2026. And what is quite interesting is that over the recent years, the topic itself has attracted a lot of interest. In fact, from 2022, we find that half of the publications are published. So 50% of the publications are published since 2022. So the evidence in the literature are quite recent, are not that dated, and hopefully the evidence present in the literature review are also relevant for the IASB. In terms of the countries that have been studied, we do note that a range of countries that report under IFRS or had their accounting standards converged to IFRS have been examined. For example, there are 6 studies focusing explicitly on Germany, which is an interesting setting because there is a country requirement for making certain qualitative and quantitative disclosures on R&D. On R&D activities. 5 studies have explicitly focused on the UK, which is also an interesting setting because prior to the adoption of IFRS, the UK accounting standards allowed optional capitalization, and that regime has attracted a little bit of interest. Then quite a few studies have looked at multiple countries instead of focusing explicitly on one country. So there are 5 studies looking at multiple countries in Europe and also beyond, using more global samples. And these studies tend to examine how formal and informal institutions affect financial reporting behavior and outcomes. What is really striking, though, is China. 18 studies have focused in China, and perhaps this is not surprising given that China Securities Regulatory Commission requires companies to make quantitative and qualitative disclosures with respect to R&D. So, for example, companies are required to disclose information about the outcomes of R&D projects and how that impacts future growth. Along with R&D intensity measures, so R&D to assets or R&D to revenue. And companies are also expected to make disclosures about any significant changes with respect to patents or business models. And for researchers and academics, this is a very interesting exogenous shock that changes corporate behavior. And it's not therefore so surprising the number of studies that have focused explicitly on China. Right? And just to illustrate how significant this mandate has been, the number of companies that disclose R&D expenditure in the financial statements has increased significantly in 2012, which was the first year, and you'll also see a gradual increase in the previous year. So effectively, companies were preparing for that change. Just to give you a little bit more of a context of how this compares to other countries, by drawing on some of our own evidence, for the period 2017 to 2021, we find that only 12% of the listed companies or entities in China do not present information with respect to R&D, and that is expensed, capitalized, and that compares a lot with other countries which would have a much higher rate or ratio, if you wish, of seemingly R&D inactive companies. Right? So the regulation itself has been quite significant, and I will be discussing some of the evidence that relate to that change towards the end of the presentation. Moving on to the key themes that arise from the literature review and the 54 publications we review, we have identified 11 distinct themes. And what effectively happens is that the articles would be covering multiple themes. And just to give you an idea here of the different topics, 28 studies examine equity market effects, and effectively these are studies that, for example, would be looking at how capitalized R&D expenditure associates with market values and returns, so on. 18 studies focus on the disclosure of R&D, and that really captures two elements of disclosure. One is narrative reporting of R&D, discussions, let's say in the management discussion section or the narrative section of the annual report, or discussion in conference calls. And within that theme, we have also identified some studies that look at the disclosure of the R&D amounts in the annual report. So think, for example, the Chinese setting, where companies shifted from not reporting to reporting R&D expenses, as I said. The third most common theme is the determinants to the decision to capitalize development costs, or the amounts capitalized. So the literature try to identify factors that affect the decision to capitalize and how much companies are capitalizing. Then about 10 studies examine firm level outcomes, and these tend to focus on areas like value creation, and that is associating capitalized R&D expenditure and expense R&D expenditure with future earnings or future cash flows as measures, if you wish, of value creation. 7 studies have examined real effects, and these studies tend to focus on innovation output, productivity improvement, and so on. Raising finance as a topic has been examined by 6 articles, and these studies tend to look at whether capitalization affects cost of equity or cost of financing or cost of debt. In general, 6 studies investigate the implications of R&D reporting on analyst properties like forecast errors and forecast dispersion, most commonly used as measures of information asymmetry. 5 studies examine the impact of reporting on R&D with reference to formal and informal institutions, and that tends to include studies that look at corruption, measures at the country level, enforcement, uncertainty avoidance, just to capture cross-country cultural differences. 3 studies focus on the implications of capitalized R&D on audit fees. 3 studies look at stakeholders' views through interviews with auditors, preparers, and investors. And 2 studies focus on corporate governance. And after this very lengthy talk, just to say, I will not be covering all those key themes. I will only be focusing on certain topics just to spur the discussion that follows after the presentation. I would like to start with the stakeholders' views, because this is the only topic that relies on interviews. Every other topic or every other thing that we have identified is effectively archival empirical research. So what we get from that stream of the literature, there are actually 2 studies that seek preparers and auditors' views. For example, Land et al. 2024 revealed that the recognition and measurement of internally generated intangibles in financial accounting relate to legitimacy. And that is effectively preparers are considering issues with respect to consistency and credibility that effectively mitigates the risk of misjudgment and misuse of the judgment associated with IAS 38. In our article, Match et al. 2019, we look both at preparers and auditors' views, and something that we note is that both set of groups raise issues with respect to difficulties in assessing the capitalization criteria. We also find evidence that there are concerns over future impairments if they recognize an intangible asset, and they're concerned also about potential future reputational consequences if impairment is to be recognized. And that is a little bit consistent with the fear of negative evaluation. And overall, both articles provided you with an insight that there is a perception that most firms do not capitalize as much as it could be expected, right? And I'll get back to that point in the next slide, but let's see what investors say about the capitalization of R&D. In fact, Madzi et al. 2022 shows that investors do have a strong support for capitalizing R&D, and they are strongly against the more US approach, expensing R&D. And despite the support for capitalizing R&D, there are mixed views over the signaling role of capitalization, the capitalized amounts. And that comes from the lack of clarity and guidance in the standard, and also the significant subjectivity when applying the conditions. Right? And in fact, what we note is that a lot of investors to go into looking at the cash spent measure as a level measure of R&D investment instead of the accounting treatment itself. Nevertheless, an important aspect that comes from the interviews with investors is that they advocate much more disclosure surrounding R&D. Now, moving into the archival literature and sort of linking it to the perception that would expect more capitalization, there are evidence in the literature that the adoption of IFRS and mandating capitalization did have an effect, the recognition of intangible assets. So, for example, looking at the evidence in Dargenado et al. 2021, that looks at the adoption of IFRS in the UK. The transition from optional to mandatory capitalization has resulted in about 50% of the companies that report R&D expense, or if you wish, the seemingly R&D active companies, do recognize capitalized assets, capitalized R&D development costs. So there has been, if you wish, a real effect, and many more assets are recognized on the balance sheet as a result of the adoption of IFRS. When we draw into the evidence from studies using more international samples, there is also a similar pattern where there is a large proportion of companies recognizing development costs. So there are some evidence that companies do capitalize development costs. Perhaps they should be capitalizing more, but for now, and a little bit in contrast to perceptions, there are strong evidence that capitalization is there. And there are assets reported on the balance sheet. Right? Moving into the literature that looks at the determinants of either the decision to capitalize R&D or the magnitude to capitalize R&D. Here I list the most commonly used determinants, and I will only be drawing on a few of them. So for example, size, bigger companies tend to are less likely to capitalize or recognize development costs on the balance sheet, and they will do so with lesser amounts. So they're not going to capitalize as much. Leverage has a positive effect. So companies with more debt or higher leverage in their capital structure are more likely to capitalize R&D, and they will do so with bigger amounts, with greater amounts. Consistent with the views and the concerns expressed in Madzi et al. 2022 when interviewing analysts, that there is subjectivity in the criteria and there are concerns about earnings management. There are strong evidence in the archival literature that capitalization of R&D is used for benchmark beating. So companies are more likely to capitalize R&D in order to meet certain earnings thresholds. Right? And with respect to formal and informal execution, I would like to focus only on corruption for now. Corruption measured at the country level seems to also have a positive effect on the probability of capitalization and also on the magnitude of capitalization. So companies in countries with higher corruption would tend to capitalize higher amounts and they're more likely to capitalize. Interestingly, that stream of the literature also shows that these companies will generate less future economic benefits from such assets, which really indicates that capitalization is used opportunistically, right? And sort of this links with the next thing that I want to discuss, which is the firm level outcomes, where the literature tends to focus on the association between capitalized R&D or capitalized development costs and expense R&D and future earnings or future cash flows. And the main question that this literature try to address is whether those assets actually generate future economic benefits as a sort of more direct test. And prior literature does provide robust evidence and consistent evidence that such assets do associate with future earnings and cash flows and therefore generate value. And despite this evidence, there is also evidence in the literature indicating that such assets are also associated with uncertainty. And typically uncertainty in this stream of literature is associated with the standard deviation of future earnings. Greater standard deviation, volatile earnings, if you wish, is typically measured as is typically a proxy for uncertainty. And what prior literature shows is that capitalized development costs exhibits a positive association with the volatility of future earnings, indicating that those assets are uncertain. And interestingly, the evidence in Dargenedo et al. 2021 indicate that this only holds for the period after the adoption of IFRS in the UK. Prior to that, there was no such event or such evidence when companies had optional capitalization under the UK GAAP.
Just conscious of time. Can we have 2 more minutes for your presentation?
Yes.
Thanks,
Okay.
Thank
Thank you, Eric. With respect to audit fees, there are robust evidence that capitalizers tend to pay more audit fees, reflecting on the greater audit effort and the concerns over earnings management. With respect to equity markets, to equity market effects, there are robust evidence that capitalized R&D is positively associated with market values, and especially so when there are no incentives for earnings management. And there are also evidence that such companies have exhibit higher abnormal returns in the future. There are also evidence that the value relevance, if you wish, or the value that investors attach to such assets has decreased as a result of the adoption of IFRS. And there are some evidence from the analysts' properties literature or topic that corroborate this argument. Moving into the disclosures, which is something that we're also going to touch on later on. There are evidence in the literature that greater disclosures would lead to more informative prices, so stock returns would incorporate more future earnings information. And this effect is driven by disclosures in the narrative section of the annual report and noting the financial statements, which is not surprising given that the financial statements would tend to include boilerplate disclosures and the level of mandatory disclosures is quite minimal. Prior literature has identified topics around the research phase or the intellectual property, so in relation to patents, to be particularly useful for investors. And this is a finding that holds irrespectively of how strict national regulation is with respect to disclosures. As I said earlier on, disclosures tend to include also companies that are seemingly R&D inactive, so they don't have R&D information in the financial statements. And there are evidence that such companies do talk a lot about R&D, and in fact, they make reference to IS 38 terms like ability to sell, ability to use, and the last slide, I promise, Eric, the evidence from China, which has been attracting quite a lot of interest for academics. The transition to mandating disclosures had a positive effect on corporate innovation, so it led to more patent output, it led to more bank financing, and it has actually improved the the relationship between R&D expenditure and cost of capital, which indicates that information asymmetry is decreasing. And firms that started revealing the R&D expense in the financial statements also experienced a decrease in forecast error. Again, consistent with the concept that revealing the R&D expense in the financial statements decreases information asymmetry. Nevertheless, there are also some evidence of unfavorable or unintended consequences where firms shift to low-level and fast return patents. Following the adoption of the mandate in China. Hopefully, I didn't take too much of the extra time, and apologies, Eric, for running a little bit late, but the literature is quite massive.
No, thanks, Dennis. So look, the presentation shows that there is a lot in this research space. There's so much information about R&D, and we really appreciate the work that has gone into this presentation, Dennis. Can I ask Dennis to pull down the presentation slide so we can now move on to the panel discussion, and we'll talk more about research and development topics that Dennis may have already touched on. So let me first introduce our panel members in first name alphabetical order. First, Amir Gander, who is the reporting and assurance leader at CANZ. And next, we have Jeff Held, who's a professor at the University of Texas and also a member of the ISSB. And we have Moana Overton. Can never mispronounce her name. It's such a famous name, as we discussed. She's a partner at Deloitte and a member of the AASB board member. And then we have Rachel Waterhouse, who is the CEO of the Australian Shareholders Association, and Ram Subramanian, who is the external reporting leader at the CPA Australia. So warm welcome to all of you, and thank you for taking the time to share your insights with us today. So before we dive into specific topics about R&D, I'd like to first hear your initial reactions to the research findings. Did anything surprise you or particularly resonate with your experience or perspective? Perhaps I'll invite Moana to provide your views.
Yeah, thanks, Eric, and thanks, Yanis, for your presentation. That was fantastic. So much to digest there. I'm probably going to need to spend a bit more time reflecting on it as well. I suppose a couple of things really resonated with me. The first was the commentary on the age of the standard. Now, that's just a mathematical fact, but if we actually think about the world for which that standard was designed and the one that we now live in. So, for example, one doesn't capitalise employee training costs because you can't control an employee. Happy days, we all understand that. What about an AI agent, right? The standard didn't envisage a world where there might be employees who are actually developed by the entity, and I don't know, do we think they're controlled by the entity or not? Greater minds than mine, I think. But clearly the world has moved on in a way that wasn't envisaged by the standard, and although we say it's principles-based, the application gets clunkier and clunkier as time goes on. The other thing I found really interesting was some of the reflections on the impact of capitalisation versus non-capitalisation on entities, because I'm really interested to hear from others on the panel as to whether they think capitalisation in itself actually does or does not provide useful information, taking into account that those 6 criteria sort of do give you wiggle room to pass or fail the test in some scenarios. So I think disclosure, personally, I think disclosure is really important, but very interested to hear how much weight others will put on the question of capitalisation or not.
Jeff?
Yeah, thanks. So super interesting presentation. As Eric mentioned, I'm a professor, so very interested in what's happening in the literature. And I just wanted to reflect on one of the things that I think is interesting and maybe understudied in the academic literature is that a lot of this variation that we see in terms of capitalization versus expensing, whether there's R&D or missing observations of like R&D, some of the differences across different countries. I think, there's probably a fairly large component of that variation that could be understood through the lens of different industries, because of the underlying business activities that are prominent in particular industries. And so, also then in different jurisdictions, countries. And so, it's something that we often, as academics, sort of bury with our research designs. But I just wanted to sort of comment that I think that's, it's just interesting to see this variation, and it makes me wonder how much of that sort of needs further exploration to understand the business drivers of that.
Thanks, Jeff. Ram?
Thanks, Eric, and great presentation, Fanis, and great research as well, both Fanis and Yanis. So excellent piece of work, and happy to be part of this. Just to add to what Moana and Jeff said, just my key takeaways were probably in the last few slides, and that was around some of the interviews and other feedback that you got. So the takeaway that I took was, more information on R&D expenditure, whether it's capitalized or expensed, does seem to have an impact on investors and how they perceive value. And it also probably is that, it doesn't have to be in financial statements. So it could be information that's elsewhere in the annual report, or perhaps even outside the annual report. That probably didn't come through in the presentation, but I have heard that elsewhere. And probably the famous reference is the end of accounting book that you referenced earlier in your presentation. Also, this detail around various stages of an R&D project, there seems to be some interest in that, but I'm not quite sure how you can unpack that in a set of financials. So that's probably a question for later, but that's something that does need to be considered perhaps as well. The other observation is pre-IFRS and post-IFRS, that significant drop in recognition on the balance sheet. And I think that's probably similar here in Australia too. And that probably has an impact. And my thinking there is, and this is anecdotal, no empirical evidence for this, but my thinking is once you have a stringent set of rules, more stricter rules on capitalization, you want the evidence there. So auditors will automatically be looking for the evidence to support what's being capitalized and what's not being capitalized. So the bar is already set higher, and auditors will want to see that evidence. And of course, regulators will also be keenly looking at those numbers. So that probably has an impact on how companies go about looking at whether something should be capitalized or expensed. And conservatism probably leans towards, expensing rather than capitalization, I would think. But those are my initial observations. Thank you.
Thanks, Ram. Amir.
Thank you, Eric, and thank you, Fanis. A really fulsome piece of research that, for me, was a great perspective to step back and just look at the breadth of those studies across many different markets, and also the over time. I really think Moana hit the nail on the head in terms of this is changing over time. There's no way to get away from the fact that it's a delicate balance. You go too aggressive, too much, turning the dials towards capitalization, and you can end up with some of the kind of disasters we've seen over time with assets that have just sort of gone up in smoke spectacularly, and you only have to check out what corporate collapses have featured on The Simpsons to think about what that looks like. But then on the other side, you go too conservative, and you've got the end of accounting, and you know that famous diagram showing that balance sheets no longer you know, reflect what they need to. So I think what your presentation really does bring out is that that sort of balance shifts over time, as Moana put so well. And I wonder how can we better keep pace with it, because we probably, while it's never going to be perfect, I wonder if that's where we might be able to do better.
Look, thanks everyone. I think those are really good comments. We talked about, so Moana talked about AI, a new form of technology. There's also comments about what should be capitalized and what shouldn't be capitalized. Also, there's also suggestions on looking at the variation of industries for more research on these. There's also other implications that we may need to consider. And also talking about how R&D information may influence decision making. So with all that, we're going to dig deeper in our conversations. So first, Rachel, I'd like to ask you a question, given that you are the CEO of the Australian Shareholders Association and you have good connections with shareholders overall. A question for you. What information do investors want regarding research and development activities? So Rachel, you're muted.
Sorry, back to COVID times, hey, with that saying. I just wanted to say it was a fantastic presentation, and just answering that question and giving a little bit of context. We monitor about 150 ASX listed companies each year, and we have a team of volunteers that do that. And so when they're monitoring companies, they're looking at it from what's the investment in R&D. But as individual investors, and I have reached out to quite a few of them, is they're really looking for, you know, what is the value being created? So there's the part that's about the numbers and how it's treated and the accounting, which is really important, the total R&D, but then the R&D by product, as far as the product development that's being put in. They're looking at R&D as a percentage of revenue, and they're also looking at how has that changed? What's that change per year and over time? They're looking, what they want to know is, does it create value? What are the objectives and milestones of that R&D? And really the narrative. And as investors, they're thinking about where they're invested and even comparisons. So they'll be looking at company A, how does that compare to company B? Are they putting enough in? What's that capitalization? There's definitely been a lot of disasters over time where, you know, that the money doesn't result in much. But that's the key thing. And they're effectively, they're a bit of a judge on, you know, is there right outcome for this investment, how it's being treated in the accounting side. So I'd say the accounting is really important, but the narrative is, and there was a commentary around financial reports versus annual report versus elsewhere. The annual report with the financials is the most important thing to most of our investors, and being able to see as much information and have good disclosure and transparency in there.
Thanks, Rachel. Any other panel members would like to? Yes, Yannis.
Thank you all for your contribution and comments. Thank you. Just to bring here something that Rachel mentioned, and maybe it didn't come across clearly in the presentation, but the qualitative interviews with investors, with it, just resonate with what Rachel said. They say that they wouldn't want the US approach of expense everything, you know. They prefer having some expenditure capitalized, but they do want more information to understand the quality of what is capitalized and the prospects of future economic benefits. So that is the trade-off there, that they do want the information and they don't want everything to be expense. So that's why at the moment they seem to resort to cash spend rather than the actual capitalized amount. If there was more reliability about the capitalized amount, that would be more helpful. That's what we've heard. And it is interesting that I think last week the IASB put a paper to the board with reflections from discussions from investors. And it seems that that also covers the points that Rachel also mentioned. So yeah, just to add that. Yeah, thank you.
Thanks, Dennis. So now we move on to about what you just mentioned, Yanis, is about the thinking of capitalization or expense. It's been an ongoing discussions for many, many years. This is not a new debate or discussions that we have heard. And Mo has mentioned just now that things are changing. There are more new forms of technologies that entities now are dealing with, and perhaps the criteria for capitalizing an expense may need to be revisited. And Jeff, for your context, in the US, I think US GAAP just expense everything. There's no capitalization at all. So for the US, there's no such debate. But I think the question was, should any of the items should be capitalized rather than, should we split to two different components? So a question for the panel members. So having consolidating all this information, some argue that not all R&D expenditure should be capitalized, and that expensing certain activities through P&L remains appropriate. I'm really interested to get your views. What is the right approach on this? Mo?
So I think from my perspective, this is most successful when an entity actually has a stage gate process where they actually say, I'm going to expense up to this point in the process, and then once I've, developed technical feasibility, all of that, and it fits in with their management reporting. How is this project actually going? Because I don't think any of us, well, I certainly hope so, would advocate for capitalizing absolutely everything, because this is innovation. Lots of things we try and fail and they don't even get off the ground in the first stage of the projects. So from my perspective, I think that to say one should never capitalise will be unhelpful to business, because there are significant amounts of money being spent, and if they're not allowed to recognise it on the balance sheet, that will become a budgetary issue every single year. That has to be fought much harder for, if you like, in the budgeting process than if it can go on the balance sheet. But then somewhere along the scale, there is that, hey, we've just got some computer programmers trying some new and funky things and seeing what lands. Somewhere along there needs to be a gap where we say, actually, here is where capitalisation starts. So I wouldn't be advocating either for all of R&D going to the balance sheet, nor would I advocate for all of it going to P&L. I don't think either of those is the right answer. But have the criteria in the standards stood the test of time, and will they continue to do so? I'm less convinced about that.
Thanks, Mona. Anyone else have other thoughts on this? Ram?
Yeah, I tend to agree with what Moana just said. What we're hearing is something similar. Conceptually, the criteria for recognition of what is an asset seems to be just about right, but it doesn't quite address the challenge we've got with innovation and research and development area, particularly research and development, but more broadly intangibles as well, which it fits under. We did have a discussion on this a little while ago. CP Australia had a summit, an intangible summit, a few weeks back, and we had a few people talk about this topic, but it was on a slightly different tangent. It was on technology, more specifically, not necessarily R&D. But one of the things that was mentioned by a presenter, Professor Michael Davin, was that, companies, when they look at entering into a project, a research and development project, they're looking at options and capabilities. So they're looking at, they need to be part of the conversation. So if someone else, their competitor, is doing something in this space, they need to be investing something similar, perhaps. And at the initial stages, it's probably almost like, you're taking an insurance premium, or taking insurance and paying a premium on it by putting some money into a project to see if it works out. And as the project progresses, you have some more visibility on whether it's going to succeed or not. So the point at which it turns into something more tangible, forgive me for using that particular word, is probably when you need to start thinking about whether it needs to be on the balance sheet. But until that point, it doesn't meet that criteria for what an asset is, because it's effectively the company exploring a particular area of interest, which they are doing so because they have to. That's the business they are in, and they need to put money into it to see that if it's something good comes out of it. So there are some uncertainties in that in initial stages, which then may turn into something more feasible down the line. But where is that cutoff? Where does it stop being an expense and become something that can be an asset? And the other issue, of course, is, if you go past that cutoff point and continue to expense, then the information is not right either, because it should be an asset, but it's not being. And if some might argue that that's perhaps a more prudent approach, because you're expensing something, but that's a loss of valuable information for investors. So we need to be able to identify where that cutoff is very clearly, and whether the standard currently does it or not is something that needs to be explored, perhaps. Thank you.
Thanks, Ram. I think that's really important because where do we draw the line? Where is the phase? When is the phase that moving from research phase into developing phase? That is the gray area. And as much as the standards give out some really clear guidance, but practically it is still a challenge. Amir?
Thanks, Eric. Yeah, look, I really agree with what Ram and Moana said, and not to put an opposing view, but I guess just looking at the cube from a different side, and relating it back to investor needs. From everything I've been able to garner, and it's hard to garner what investors' demands and needs are a lot of the time, almost all the time, but I think that they are very happy for there to be uncertainty, and they know that there's uncertainty in these types of bets, and that's the game. But what they don't like is opacity, and when it's not transparent enough. And that's where I start to think, okay, purpose of financial statements, and we have the kind of, I guess, Ocean Tomo chart / end of accounting view where it becomes this perfect theory of everything type model of what a company is when you look at the balance sheet. Then you've got the more realistic, okay, this is just a way of giving the investors some useful information they need for decision making. And that's where I start to maybe lean a little bit more towards the United States model, thinking that investors know that where that line is drawn that we were just talking about is highly subjective. And I don't think we've really ever got it, right. And we're still working on it. But that doesn't matter as much to investors as having a fulsome, explanation of the strategy and the risks, etc., to the extent that is commercially reasonable. And also, having transparency around what's going on. Therefore, if it's through the profit and loss, or it goes through or it's on the balance sheet, that's maybe of less consequence for investor. I don't have a study to back that up with, but it's just a different way of looking at it.
Thanks, Amir. Yanis?
Just to add a little bit on this context about the information and whether it is in the income statement or on the balance sheet. One thing that, for example, research shows is that investors, they want information even for what is expensed. So is it because, it is something they are developing, but really one of the criteria is not met? Or is it really exploration, kind of like Ram mentioned, which are two different things, right? Or for the capitalized amounts, is it enhancement of an existing product, or is it something new, right? That is some nuances that we have seen in the literature that investors are looking for, and that would add value, I think. Yeah.
Thanks, Yanis. And in terms of the ratios, we heard that investors would like things to be capitalized so that they can look at return on assets with a better picture. But at the same time, I have heard that panel members are saying, look, investors may want other information, may not be just the dollars amounts on the balance sheet. So I guess the next question is, what narrative information you think preparers can do to help investors better understanding the R&D activities? I'm going to ask Jeff this question, given that you mentioned about industries, variations just now, and also you are also an expert in metrics. So I'm wondering whether you have some thoughts on this.
Yeah, well, this relates to some of what we were just talking about. I think investors are looking for understanding of the drivers of value, and so sometimes that will come out in a narrative form. Sometimes that can come out in specific activity metrics. So when you think about what we've heard from investors when it comes to sustainability disclosures to help them make better decisions. They want to understand the risks and opportunities that companies are facing. They want to understand the company's strategy to dealing with those risks and opportunities. And that's going to oftentimes need to be accompanied by metrics that would be relevant to understanding how a company's making progress on that. So one of the things that that we focus on at the ISSB is to ask not just what are the risks or opportunities that a company might be facing, but how do you plan to address them, and what do you think the financial effects are going to be? So, are you deploying capital to develop the new products because of a risk that you're facing, and how do you anticipate that's going to affect your financial statements going forward? So, trying to really kind of like help connect some of the dots there, and in different industries, we do see focus on different types of specific metrics. So looking at, for example, what kinds of cars are you selling? With different types of engines, hybrid versus zero emissions. Where are you selling them? Would be one example in a specific industry. But if you were to look at like meat, poultry, dairies, or agricultural products, thinking about how evolving weather patterns or customer preferences might be leading you to try to like innovate to develop products and services that are going to be the ones that you're going to be selling in the future, not just the ones that you're selling today. So that's some of how we see the connections between sustainability disclosures and the financial statements that they can accompany.
Thanks, Jeff. Rachel, do you have any things to add on to the comments?
Yeah, I think Jeff explained it really well. Investors really want to know the why in the narrative. So why this is happening, what are the next milestones, really get an understanding of the detail. And I know not every investor wants that, but investors should have access to that level of information. And ultimately, part of this is around, well, what is success? What does it look like? And from our perspective, we're always asking boards questions around their oversight ability. So from a narrative perspective, we also want to know how the board and management are oversighting R&D and innovation and what it's going to lead to. So again, just more transparency is ultimately the ask that we're looking for companies. And there's all different ways that you can treat it from an accounting perspective. But I think that's really important. And also, when things don't go right or not to plan, just to be upfront around that with investors. No surprises.
Thanks, Rachel. Any other panel members will have something to add on to this topic? No? Okay, so we have two Q&A questions. The first question that we received was, can we capitalize bonus pay to developers working on the capitalizable development projects? I feel like this is a very technical question. I think if I ask Mo this question, Mo, I would say depends on facts and circumstances.
Don't even need to say anything.
Thanks, Mona. I think we would say it depends on facts and circumstances. Mona, do you have anything to add on that, or?
To give a little flavour of
Yeah.
what will be the yes and what will be the no. So if I have a development project and I have said to someone, you will get a bonus if this product succeeds in this time frame, and it's within the development phase of 138, and there is nothing else you need to do to earn that bonus. This is your full-time job right now. Happy days. I could probably get there. If it is a bonus going to the manager who sort of supervises that project, that dips in and out of it and is doing lots of other things, and who really knows why they're getting the bonus, then probably not. So it is that very specific linkage. The more specific it is and the more easy it is to demonstrate that the only reason that bonus was paid was because of this project, the more likely it is that someone would agree that it ought to be capitalised. But I will go back to Eric's original answer being exactly the right one. It depends on facts and circumstances.
Thanks, Mona. The next question I've got is whether a write-back of previously expensed cost of R&D be permitted. Otherwise, the subsequently capitalized assets will be measured below its actual cost, therefore not quite right. Is this a question that Ram, you would like to respond to?
Yeah, I can give it a go.
Okay.
I think the presumption there is when the R&D costs are expensed, it's because they didn't meet the criteria for becoming an asset, recognition as an asset. So if they didn't meet the criteria for recognition as an asset at that point, I would say that remains as it is. And therefore, anything subsequent on the same project, which does meet the criteria for recognition of asset, would be capitalized from that point onwards. So to me, I'm not sure you can write back the costs unless someone got it wrong. But the expense remains as it is on the presumption that they got it right in the first instance.
Thanks, Ram. All right, so I've got someone would like to speak. Michael has speak. Michael, I'm letting you to
unmute.
Yep.
Can you hear me, Eric?
Yes.
Fascinating discussion. I just, we've touched on this, but I'd just like to stand back a bit from the whole question of capitalisation. We have a real intangibles reporting gap out there. And I think that the work of Ocean Tomo really bring this home. For those of you that aren't aware of Ocean Tomo, that's a US intangible asset consultancy, and they've been at this for 25 years. But the most recent report says that 92% of the market capitalisation of the S&P 500 is not on balance sheets under accounting standards. That's a massive gap for investors to need to fill on their decision making. And I think it's gone a bit beyond standard setting here, because standard setting is constrained by the conceptual framework for financial reporting. You know, the recognition and measurement, it's never going to get there. It's never going to make up the whole sort of gap there. And the research efforts around intangibles over the decades have tended to seem to focus almost exclusively on better ways of accounting for money spent on intangibles, rather than better ways to communicate value created from the investments made in intangibles. So we regard that as a reporting issue and not a standards issue, because the standards can't fix this. And IFRS sustainability disclosure standards will make a contribution in S1, but you're not in the same ballpark. For us, the only answer here is integrated reports, because the integrated reports are built on communicating to investors and others the governance of the organisation, the strategy of the organisation, the business model or integrated thinking of the organisation. And an intangibles company, this is going to be key to it. It's those sort of things. And in that context, the KPIs measuring performance and prospects. I mean, they're the sort of things that investors really want. We don't want to put this on balance sheets. We want to give the investors and others the raw information that they need to make their decisions. So in Australia, we have very soon coming up the External Reporting Board, currently before Parliament. We are clear in our advocacy is that we would like a fourth board of the ERA to be formalised, and that would be an external reporting board that deals with the intangibles reporting gap, that deals with the productivity mess that we've got in terms of cost, volume, and complexity of reporting overall, and thirdly, how to best bring in this in an integrated reporting context. We just think that there needs to be a bit of accountability for these reporting as distinct from standards issues. It's never been there. There's never been a body. So we think it's time. So I guess, Eric, that's more of a comment than a question, but the question could be whether anyone's got any reactions to that.
Thanks, Michael. So it all comes back down to how do we solve this problem, right? Because we have been hearing that investors will like more information on the balance sheets, capitalize them if it's appropriate because they want to find out what is the return on assets, for example. At the same time, practically it's not easy to do so. And then at the same time, investors will like more narrative information, but then we know that there's boilerplate problems. We know that preparers are concerned about proprietary information. So it's such a complex topic. So I guess I'd like the panel members. Actually, Mo, you have your hand up. Before I continue.
No, sorry, I was going to respond to where I think your question was going.
Okay, so yes, so my question, great that you have this crystal ball that is, what is this future directions that we should think about in the standard setting perspective? How do we help our preparers and also users to get the information?
Well, interesting question, Eric, because when you said, how do we solve this problem? I don't know how many other people on the call finish that with, how do you solve a problem like Maria? But I'm guessing it wasn't only me. And the follow-on line to that is, of course, how do you catch a cloud and pin it down? Seems to be a little bit the problem that we have here, right? There's a huge amount of research and development and innovation going on. And as Michael alluded to, actually the accounting standards aren't necessarily designed to tell that story. So they can tell a story of whether you've ticked particular boxes or not. But they're probably not really designed to tell the full story of an entity's innovation journey, and somehow that does have to be integrated into the reporting material. Now, whether that's through a fourth board or any other solution, but I do think it is a case of trying to catch a cloud and pin it down, and accounting standards can't pin this cloud down.
Good point. Thanks, Mo. Ram, you have your hand up.
Thanks, Eric. I think the future, we do have an idea of the future direction because the IASB has got a project on this, and we are all doing some work on it some way or the other. The UK Endorsement Board has got a project on it. The AASB is doing work on it. The organizations represented here are doing something or the other on it in some way because we're all invested in this topic in one way or the other, I think, and we all acknowledge that there is something that needs to be done, but we're not quite sure what that something looks like in the long term. I think coming back to that point I made about the summit that we had a few weeks back, one of the things that came out of it was the immediate solution seems to be in the disclosure space. Perhaps there's some consideration need to be given to disaggregation and disclosure as a starting point, perhaps. Just to that point that Fanis made during his presentation on the voluntary disclosure arrangement that currently sits within AASB 138 or IFRS IAS 38, paragraph 128B, specifically from memory. There was some research done on that from Melbourne Uni, Professor Devin again, where they looked at companies in Australia that were making voluntary disclosures on expensed intangible costs, not R&D specifically, but more broadly intangibles. and they found very little disclosures that were being made voluntarily. So if the voluntary approach doesn't work, and we seem to be asking for more disclosures, what will work? I suppose maybe that's the question that needs to be posed by everyone and the standard setters to think through and see if there's an answer that maybe immediately lies in the disclosure space, followed on by something a bit more robust, perhaps.
Thanks, Ram. Amir?
Yeah, I guess as a slight slightly different direction to my comment earlier, where I was talking about, investors just care about understanding what's going on, the narrative. I think that reflecting on integrated reporting and the journey that framework has had so far, as well as maybe the broader sustainability reporting movement at the moment, does show how much investors gravitate back to the financial statements as a really core piece. Not that it's everything, but what's actually tied onto the financial statements does seem to take primacy. And must say personally, I had really high hopes back around 2013, 2014 that the integrated reporting framework capitals would be developed a little bit further into I guess, a more a model akin to the accounting equation, or that was more of an extension to the accounting equation rather than really a basis for narrative reporting or thinking. That hasn't happened, and I think that some of the challenges that we've had in sort of advocating for integrated reporting to be taken up illustrates the fact that while so much of this is about the story and investors want to understand the story behind the numbers really do matter a lot at the end of the day.
Thanks, Amir. Okay, so I've got another question, and perhaps Jeff is the best person to answer this question. How could sustainability reporting frameworks, including IFRS standards, intersect with disclosures relating to research, development, and innovation activities, particularly climate-related innovation and transition strategies?
Yeah, it's a good question. I think that I agree with some of the sentiments that have been shared about the importance of disclosure, and disclosure can do a lot to help investors get the information that they need. One of the things that's unique about sustainability disclosures as well is that we're not necessarily talking about just things that have happened already. And so we can, because a lot of times what investors want to know is like, what are you planning to do? And so when you think about that information, you can start to think about the plans a company has to develop new products, even before they maybe have started to spend money on them, but over what time period might they be planning to do that? So that starts to add to the picture of what somebody could get just from the financial statements, and even thinking about the integrated reporting in these different capitals. I like to share an anecdote from the response I got to a student one time when asking about what's the difference between human capital and intellectual property or intellectual capital. And the student said, well, is it inside your head or is it outside of that, in a sense? And so if it's written down, if it's patented, et cetera, then it starts to have a different sort of profile of risks and opportunities versus when it's still inside of the employee and you need the employee to show up at work and to do the thing that they have the know-how to do. And I think sustainability disclosures can provide additional insights into human capital. ISSB has a research project on human capital, and that can help you understand the role of what your employees are doing to help drive value inside of a company. And that's often at times related to things like innovation, and maybe before it sort of starts to develop into specific products and services and things that are sort of reside more outside of the employee. So again, investors are looking for as much information as they can get about the full picture of the drivers of value that a company is utilizing. And so I think sustainability information can help play a complementary role there.
Look, thank you so much for your time today. I'm conscious of time. It's 1 minute to 5:15. So please join me in thanking Yanis and Fanis for their presentation, and our panel members for sharing their thoughtful perspectives. As is often the case, the dialogue series sessions doesn't necessarily give us all the answers. Instead, they raise important questions and help us to shape this conversation. And we hope this conversation also has helped you to think about the challenges of research and developing accounting and reporting. We also like to thank CPA Australia and CANZ for their partnership and ongoing support. Our next dialogue series events will be held in June, and the topic will be about grants accounting, which is another important topic to think about. So keep an eye for further details. Thank you again, and have a wonderful evening.